नेशनल इंफ्रास्ट्रक्चर पाइपलाइन प्रोजेक्ट की। इस पर 110 लाख करोड़ उससे भी ज्यादा खर्च किए जाएंगे। इसके लिए अलग अलग सेक्टर्स में लगभग 7,000 प्रोजेक्ट्स की पहचान कर ली गई है। इससे देश के ओवरऑल इंफ्रास्ट्रक्चर डेवलपमेंट को एक नई दिशा भी मिलेगी, एक नई गति भी मिलेगी।
Well, that was the big Independence Day message from the Prime Minister. Good morning and welcome to Bazaar Morning Call. I'm Lata. Anuj is with me. Sonia is joining from her home. Well, actually, the bulls had a huge bashing. Maybe the late entrants, not all of them, but the late entrants had a huge bashing on Friday. We ended rather deeply in the red, especially for the Nifty Bank. So today, I would assume there is a bit of a hesitation to go all guns blazing. And the results, well, there were not much that you could speak about. There were predictable good news from the pharma sector like Glenmark. Berger was a fairly decent number, but otherwise most of the results were bad and they were expectedly bad. It's not that they were a shocker, and most of the companies have guided for a decent Q2. So we are not getting any big cues from the results over the weekend, except that pharma perhaps will once again hold the flag. My sense is the Prime Minister's speech that there is an infrastructure pipeline that is being planned and where details are getting ready is going to be a big sucker for the bulls. That might put a bottom to the market. Good morning, Anuj.
Good morning, Lata. You know what, the data that we have and the market pattern that we have reminds me of the fall that we had on 3rd August. On 3rd August, it looked like the market was breaking down. We went to 10,882 and closed at 10,891. So, and what did the market do next day? It rallied 200 points on the Nifty. So now I'm not saying that we'll have a 200-point rally, but it won't surprise me. And that's the point we made on Friday as well in closing bell, that this is a buy on dips market. It will keep shaking out a lot of people. Whether you can stay through the shakeout, that's up to you. And what's the market done is on Friday it corrected to the 20-day moving average. Anyway, the moving average has moved up and the Nifty has fallen there. So now you have a very decent sacrosanct stop loss in place, which is 11,111. Which was the Friday low. I would have preferred if we didn't have, and that's why, again, I believe time has come for index to be available trading throughout, because, you straight away now have a gap up to deal with. But the other thing is I want to watch out for is how Reliance will react today, because there's a bit of an overhang now after what happened on Friday in terms of that AGR hearing. So that is something that I'll keep an eye on. Let's see. Also, the Asian market has shut by the time we had fallen in last hour on Friday, and we were reacting to the European cues. And this morning, Asia is actually up. So that way, we've already presaged a lot of weakness, and now things are looking up once again. So it should be a good day. Now, the bank Nifty is an issue because that's now down 33% this year versus 8% for the Nifty. So that's the underperforming part. It will be important to see if that one sees some short covering today, or is it back to Reliance, IT, Pharma, those kind of stocks to take leadership. One last point. The mid-cap market has looked good, but I think now I'm getting a bit worried about the kind of stocks hitting F&O ban. And I think now time has come to seriously look at it. I've done a study as well, of course, on this. But now, even Ashok Leyland, Muthoot, Manappuram, Aurobindo Pharma, a good, large pedigree stocks are also hitting F&O ban. That creates a bit of a problem for the mid-cap market. But overall, I think today should be a good day. Let's see.
I take your point, especially the fact that people are creating open interest by out of the money calls and options, and that's taking away some of the stocks in play. Good morning, Sonia. Feeling lonely back home there?
Yes, really lonely and missing all the action in the office. But, on that subject, Anuj, of the banks, there was delivery-based selling in quite a bit of banks on Friday. So overall, there was DII sold about 800 crores. But if you look at financials, Axis Bank saw about 800 crores of delivery selling. HDFC saw about 700 crores. So do you get a sense that the underperformance that we've seen in banks so far compared to the Nifty is something that could continue? Or is this a time when things could perhaps change up a bit?
Sonia, there are two ways to look at it. One is just the near term for the day. If the market has to see short covering, it will be led primarily by financials. But if you look at the larger term trend, like I said, this market's leadership change has been tectonic. And even something like an HDFC Bank, where we had the rally that day when Aditya Puri's successor was approved by RBI, actually has now fallen below that level. So in that sense, there it is. In that sense, there's one thing which is very clear, that banks are no longer the leaders of this market. That leadership has moved to IT and pharma and Reliance. So that way, in the positional scheme of things, it's really the non-banks which will do better. But just for the day-to-day, if the Bank Nifty holds out Friday's low, perhaps you would see some short covering in the Bank Nifty as well.
Okay, I'm more worried about how the bond guys are going to read the RBI dividend. It is much lower than expected. But the point is, there are three ways in which the Reserve Bank creates money. It either gives dividend to the, how does it give? The Reserve Bank is not a manufacturing company. It has no profit. When it is giving money, it is just printing money and giving it to the government. If it gave less to the government, the positive interpretation could be it can buy more bonds and dollars. That could be the positive. The negative could be, if it gave less dividend, the government already is tax strapped, and with even less coming from the government, from the RBI, the government may have to borrow more. So I'm not very sure how the markets will react. If the bond markets react positively, that could be a bit of a leg up for the Nifty Bank. But we'll have to wait and see. This can cut both ways. Okay, so that's on the bonds. Now let's shift to equities, and here's some opinion coming for you. Varun Dochav of HDFC Securities says their brokerage expects Q2 and Q3 results to be better indicators of the underlying demand conditions and stress in the banking sector. They believe the market will await more concrete evidence of a sharp FY22 earnings rebound, which is currently built in. Their preferred sectors are telecom, IT, chemicals, pharma, insurance, large banks, cement and gas, while they're underweight consumption. HDFC Securities' large cap picks in the model portfolio include Reliance, Bharti Airtel, Infosys, ITC, SBI Life, ICICI Bank, Axis Bank and L&T. In mid caps, they like Max Life, IGL, Gujarat Gas, Crompton Consumer, Alkyl Amines, Galaxy Surfactants, JK Cement, KNR Construction. Oh, that's a mouthful.
Okay, that's a long list of stocks to work with, but let's get you some money market views as well. On the rupee this morning, we have commentary coming in from B. Prasanna of ICICI Bank, who says the global dollar weakness continues with growing optimism in Europe's rebound, accompanied by concern over the deadlock in the US relief package, as well as concerns on the spread of the pandemic in the US. Any impending policy talk of average inflation targeting or yield curve control would reignite a fresh round of dollar bearishness. Back home, the continued moderation in monthly trade deficit argues well for a rupee, even as persistent RBI intervention is keeping the rupee strength in check. Given this, he expects the range trade of 74.75 to 75.25 to continue this week.
Okay, yes, there was a minor trade deficit, fortunately, unlike the previous one, then we had trade surplus. On the bond markets, Prasanna says the MPC's clear focus on witnessing a durable reduction in inflation has effectively postponed any possible rate cuts to the fourth quarter FY21. In the interim, bond market has become more susceptible to rising global bond yields and continued local supply risk in the absence of any RBI demand-side measures. Overall, he expects the upward pressure on yields may continue, and the 10-year benchmark bond yield may move past 6% in the near term.
Okay, let's talk